And we're live. Simon, welcome to the show, man. I'm pretty excited.
Hey, Satch, appreciate you having me on the show again. I've listened to a couple of your episodes now, and I'm really excited to be on the show. And hopefully, I can provide your listeners, some value and telling a little bit about my story and the journey in real estate investing.
I love it, man. I'm pretty confident that you will. Let me give a quick intro to Simon. Simon Castillo is a real estate investor and business development executive from San Antonio, Texas. Simon began investing in real estate in 2004 and is currently invested in more than $52 million dollars of single family and multifamily assets. He is the principal and founder of SAS Texas Capital, a real estate firm focused on raising capital for the acquisition of value add Class B and C multifamily properties. SAS Texas Capital currently has interest in over 370 units in Texas. That's pretty awesome, Simon. So you've been an investor since 2004. Can you walk us through what were you doing before that? Is has been real estate the only thing you've always done? Were you a W-2 employee in something else?
Yeah, no, actually, when I first started my journey into real estate, I was a W-2 employee, working full time, and I just knew that working a W-2 job was not going to be the path that would lead me to building true wealth. It's the 9 to 5 and investing in a 401k. For most people is great, but I knew for me wasn't gonna get me to where I wanted to be. Um, and the only thing I knew at the time would be, buy single family homes and turn them into rentals. And that's the path that I went down on. And, I did that for close to 17 years. And, over that time, and it wasn't 17 consecutive years. Like there was probably a period of a year or two here and there where maybe I didn't buy a property at all. But, um, over that time, though, I did have experience, with rentals, fix and flips. I even did a couple of homes, spec homes where I built them from the ground up. So, a lot of valuable experience. But it wasn't until recently, within the last 3 years, that I discovered, investing in multifamily. And, really for me, the struggle was always, if I can buy a property here or there, single family property, it's just not going to scale to the point where I want it to be. And for me, multifamily was the answer. I just didn't know how to, I didn't know how to cross over from single family to multifamily.
What was the thing that made you cross over?
So, about 3 years ago, I really made a concerted effort. I was like, I'm going to buy another property this year, and I'm in San Antonio, so I was looking all over San Antonio for a property to buy, um, and I just couldn't. The numbers just wouldn't work. After renovation costs, closing costs, down payments, everything added up, my cash returns were less than 2%, and it just didn't. The numbers just didn't make sense. The market here in San Antonio has been very healthy and very robust for a number of years. Um, so I started joining real estate meetups and trying to meet other people who were trying to do the same thing I was, and maybe they were having more success. I was wanting to learn from those people, and I was fortunate enough in these meetups to meet people who were doing multifamily through syndications. And when I started hearing their stories about how they're, I just closed on 150 units, or I just closed on 200 units. I'm like, if these guys can do it, or if these people can do it, then I can figure it out, or I can find a way to do it too. And that kind of started me down that path. I started to network more. Joined a local mastermind and found a mentor, and that's really what kind of propelled me into multifamily.
Dude, it's so funny, man. I so many people that we bring on a show, they start in single family. I started in single family as well. And once you start doing multifamily, you look back and you're like, why was I not doing this since the beginning, right? And I don't know if it's just a mindset shift that happens, or a lack of a mindset that we need to have starting off to realize that, hey, you don't need to start in single family, right? It's not a I think the common theme on things in life is that you gotta start small to go big. But in real estate, that's not a thing, right? It's like it's two different worlds. And single family is not a precursor of multifamily, right? You can go straight into multifamily. It's a whole different field. Um, so I love it, man. You've been investing so for single family homes, and how did it go? So since 2004, so how was it for you going through the recession?
You know, I was fortunate going through the recession. Um, most of my properties were buy and hold, so I had tenants in them. They were cash flowing. So during the recession, I knew a lot of other investors who got caught holding onto properties that they were what I would call speculating on. So they were buying them, trying to flip them, or hoping that the price would just appreciate enough for them to turn them around and sell them. Most of my properties were cash flowing. I did have a higher turnover rate, between 2008, 2009, even into 2010. Uh, but fortunately, even the ones that had vacancies, I was able to move in another tenant, fairly quickly. But for me, the lesson learned during that period was, cash flow is king, especially in real estate. There you go. I hadn't even seen your T-shirt, but yeah, cash flow is king, and cash flow is what helps you to really kind of navigate, those turbulent, economic times. Um, so especially as we are kind of in uncertain times right now, I keep going back to that same lesson I learned back in '08, '09 was, if I'm looking at properties now, if I'm looking at multifamily, now, uh, first and foremost, is it cash flowing? Will it cash flow from day one? Because that is what helps to get you through those uncertain, economic times.
Love it, man. I 100% agree with you, and it's the same theme I keep seeing over and over. Anyone that was successful through the recession says the reason why they got through the recession is because their assets that they own were cash flowing. Cash flow through in real estate is what got them through the 2008 recession. Anyone else that was speculating, doing ground up developments, got caught with their pants down, right?
And
And
it may seem kind of boring, but most of the properties that I was holding at the time were just properties that I put 20% down on. So there was some equity in them, because of the larger down payment. There was more room to cash flow, and there were so many people that want to get into real estate and wanted to get into real estate because they hear the myths about the no money down and the creative financing. Yeah, and there's ways to do that, but you also take on a lot more risk, when things go south. So for me, it was kind of boring, vanilla, 20% down, but that cash flow just kind of really helped to navigate those times.
yeah, that's what does the trick, man. The boring stuff. And yeah, most all assets that we have right now, we have in equity more than 25% down, like nearly 35% down on every single asset across the board. So it's boring, right? It's like our leverage is not that great as if we would have only done like a 20% down. But hey, at the end of the day, it's like we're not here to make the quick buck, right? We're here to make sure that we have stable assets, we're producing returns for investors, and we're being safe. Um, you said this brings me to another topic that I wanted to cover, which is the underwriting. You said that one of the things you look for in the underwriting is cash flow. What else do you look for in an underwriting to be conservative?
Yeah, underwriting is so tricky, right? Because when you underwrite a deal, basically you're analyzing and you're trying to project, what you think the future, cash flows may be and expenses, and as soon as you finish underwriting, it's almost like you already know you're wrong, right? Because so many things change. Uh, so for us, what we do, me personally, especially what I do when I underwrite a property, especially initially, is I'm very conservative in terms of rent increases, vacancy rates, and expenses. So I always overestimate what I think expenses will be, and I underestimate what I believe the rent growth will be. So, for instance, here in San Antonio, in the past in the past year, rent increases have been easily double digit, 14, almost 15% in San Antonio. But when I underwrite a deal, I'm using probably 4 or 5% because I think that's a very conservative number. And if the deal will pencil at that number, anything else that we do on top of that is just going to be uh, gravy for our investors. It's just going to be the whipped cream on top of the dessert. So
Right.
um, does it mean that we miss out on deals? Probably. And we'll massage the numbers, just to I'll take a pass at underwriting. I'll have one of my partners look at it. And they'll kind of look at it and put their spin on it. But we really don't go much further past using 4, maybe 5% for rent growth. We also overestimate our expenses. Um, Especially if it's a value add opportunity where we know we're going to go in and do renovations. The cost of everything has gone up. So, uh, in the years leading up to this year, we would use 3%, 4% for expense growth rates. Now we're using it. Again, 5, 6% for expenses. Um, and I think that helps to keep us honest. And like I said, if a deal will pencil using our conservative numbers, then we're pretty comfortable that we can move forward and negotiate with a seller.
What do you usually do for vacancy rate?
It depends on the property. It depends on the property. If a property has a high vacancy, say property has 95+%, current vacancy. That's great. That's excellent. But we also know that when we go in there with our new property management team, we're probably going to see a dip or an increase in vacancy as we clean out people that are late. We may have to evict some people. As we renovate units and increase market rents, there may be some people leaving. So we may see a dip in vacancy, say down to like 90%. So we try to factor that into our underwriting, knowing that the first 3 or 4 months is kind of stabilizing the property as we come in and renovate and bring in new clientele. So we try to bake that into our underwriting to make sure that we account for that.
And when you're doing the value add phase of the business plan, which maybe like the first or second year, how do you underwrite the vacancy? Do you do more like 12 to 15%, or do you keep it at like a 10%? How do you calculate that on the underwriting?
Yeah, first year typically we're right around 12 to 10%. 10 to 12%, and then we'll gradually over a 5 year pro forma, we'll gradually lower that number, but we rarely will take it down below 7 or 8%. Again, just to be conservative, knowing that with our property management team, we should be well below that number, but we'll keep it at 7 to 8% just to again be conservative.
Cool. I like to bring these numbers up because I don't expect most of our audience, which are busy professionals that are looking to invest in real estate deals, I don't expect them to like know how to underwrite a deal from A to Z, but at least look at some indicators that might tell you, hey, this guy is being realistic and his underwriting is conservative, or hey, this guy is just trying to fluff up the numbers, and it's just not making sense. Well, I like these numbers they're giving out so that people can be aware of those and look out for those in the underwriting. What kind of percentage would you say that people should expect to see as far as the ratio between income and expenses?
You know, that's a great question. I think the way that we normally underwrite is we're looking at debt service coverage as a ratio, and typically we want to be at 1.5 or more in terms of the debt service coverage ratio. And for people who have a finance background, they'll recognize that number as, the uh, the amount of times that your net income can cover your debt service payments. So we definitely want to be at 1.5 or higher. When we underwrite, and then, but like I mentioned earlier, once you finish underwriting, it's such a nuanced science, right? Because really, what you're doing is you're trying to project numbers that are going to happen in the future, and it's as soon as you finish, you're basically already wrong because assumptions have probably already changed.
Yeah.
But one thing that comes out of underwriting, though, that I think is very helpful is your year one, outlook. But that's probably where you're going to be your most accurate, right? Is year one, and then once you get further out, 2, 3, 4, 5 years out, your numbers probably become less accurate because there's less certainty as to what's going to happen. So in year one, if you're able to cash flow in year one, if you're able to hit your numbers in year one, I think that gives us an additional level of comfort.
Yeah. And as far as like sometimes we see as far as expense, so like if we have an income of $1 million year one and then expenses, I see them usually hover around 400 to 400,000, right? So it will be like a 50% ratio, 40 to 50% ratio. Would you say that's realistic? I've seen some underwritings where some guys put 30% expenses uh, in. To me, that's just probably some. They're either probably missing something in their underwriting. What are your thoughts on that?
Yeah, that's a good question. I personally have never seen anyone that aggressive, but I wouldn't doubt it. But yeah, when we do our underwriting, we typically don't go below 50. And again, depending on year one or current year, if the property is at 58, 60%, expense ratio, we may underwrite it, the first year to maybe we'll be more efficient, year one, maybe we'll get it down to 55, 52 maybe by year five, but we typically won't go below 50%. Again, even though we think we'll be more efficient with our property management and management of expenses, we're going to be conservative, and we won't underwrite below 50% as an expense ratio.
Yeah, yeah, I like that. Where you're focusing a lot on capital raising. Where are you finding most of the investors that are investing with you?
Yeah, that's a great question. I'll tell you a little story about myself. So I'm a natural introvert. So when I go to these networking events and meetings, like I come out of there and I'm like exhausted. But I take a different approach. So when I network with people and other investors, I try to maybe meet one or two people and then really have like a deep conversation with them, because that's just more of my personality is having kind of a longer, deeper conversation with one or two people versus trying to say hi and bye to 20 people, which to me just doesn't feel right. So when I first started crossing over into multifamily, my initial thought was I'm gonna find a property and I'm gonna be a lead sponsor. I'm gonna be a general partner and I'm gonna put the deal together. It's just gonna all fall in place because that's how it was with single family, um, and it didn't work out that way. So I kind of shifted focus and I thought, well, let me raise capital, and that way I can be a part of a deal. Even if it's a smaller part of a deal, I'll be a part of a deal, um, and that way I can kind of get my foot in the door and expand my network. Get access to more brokers and more deal flow and things of that nature. Um, so I really shifted, in terms of my focus and focused on capital raising. And LinkedIn has been probably the number one place where I have attracted investors. Uh, you often hear, friends and family are your go-tos when you start capital raising. Um, but honestly, most of the people in my deals that have invested with me were not part of my, immediate network. And I think it just worked out that way. I'm not one of those people that came in that had an existing, network of, high high paying, doctors or lawyers. So I really kind of had to start from scratch and build up that network.
Yeah. So, do you find that most of the people in LinkedIn are just total different backgrounds? There's no one specific avatar that invests with you. It's just all
So
across the board.
far,
Yeah.
so far it's been so far it's been a variety of backgrounds. Finance professionals, um, a couple of attorneys, doctors. Uh, so so right now it's kind of a variety. Um, but I think as I focus more on raising capital, I think that'll change over time. Um, and busy professionals are really kind of the target audience, but I think I'll continue to even niche down even further, and maybe just target high paying engineers, doctors, attorneys, people who have always wanted to invest in real estate, and probably thought the only way they could do it was to buy single family homes, and they didn't have the time to do that. So they've never taken the leap into investing in real estate.
Yeah, for sure. Dude, walk us, prior to getting on the show, we talked about a deal that you recently closed. So talk to me about that deal.
Yeah, so we actually just closed a couple of days ago on 144 units, multifamily complex here in San Antonio, Texas. It was a $12 million property. Um, we love the location. It's located in the southern part of San Antonio, which is undergoing massive changes. Lots of businesses that are moving in that direction. Population is moving in that direction. There's very little competition, in the area, and there's no room um, in the area for any new construction, new apartment buildings to be built. So we really love the location. Um, it's kind of a classic value add. The previous owner, I should say, um, had owned the building for over 10 years and was not looking to add any more capital expenditures to modernize the building. Had really kind of fallen behind in terms of managing the property properly. Was falling behind in terms of keeping up with market rents. So for us, it's a great opportunity to go in and do some renovations, not only to the units but to the grounds. Nothing structurally that we're going to do. It's a lot of it is painting, resurfacing a lot, the parking lot, maybe adding some covered parking, some new signage, and then the units themselves will get new flooring, new paint, fixtures, and maybe some appliances. So it's a really a traditional value add business plan that we'll be executing over the next few years.
Love it. Love how these value deals are so cookie cutter, in the sense of, I'm more than anything just want investors to see how repetitive this process is, right? For many people that have only invested in 401ks, they might see this as a new thing, right? So like a new concept, but it really isn't. It's like the value add is the most, like this kind of deal that you just mentioned is the most cookie cutter thing that is out there, right?
Yeah, I mean, when you think about it, it's the way I explained it has been, that value add business plan has been in real estate for hundreds of years. You probably, from the first real estate transaction that ever occurred, was probably a value add where someone wanted to come in and buy something below market, and then add value to it, and then turn around and make it more valuable and sell it. I mean, it's a pretty classic type of business plan. Um, but one of the things that surprises me is the amount of time that we got this property under contract, I think back in April. So during almost 4 months that it took us for due diligence, we had our property manager go on site, do a full lease audit. We had inspectors go on site to inspect the property, attorneys drawing up the documents, mortgage lenders reviewing all the work that's being done. The amount of due diligence is so incredible for me. Um, the level of safety in these types of investments to me is just unparalleled, because there's so much volatility in the stock market, even during times of economic uh, growth. there's always going to be volatility because someone can come out and say something about XYZ, and that stock, drops, 10, 15, 20%. Who knows? Uh, but the value of real estate is so stable because it's not based on what anyone, says or thinks. It's based on what the operating income is of the property. So if you're managing it properly and you're increasing the operating income, you're increasing the value of the property. So you're able to force depreciation in that asset. Um, and it's not, you can't sell. It's not at the whim of the financial markets where, people buy because someone said, hey, look at this company XYZ, go out and buy it, and people will go out and buy it without doing any due diligence. So
Right.
it's just amazing to me, how emotions play such a big part in how people invest.
Right, right. Yeah. When have you seen guys that invest in the stock market go and read reports, finances from those companies that they invest in, right? Never.
Right.
It's all emotionally done. So the fact that we put in this much work and show it to people before investing in a deal, I think is very valuable, right? And then you have obviously you have the syndicators doing the underwriting. Then you got the lenders doing their own underwriting. Then you have the property management company doing their own underwriting, and then you have the syndicators doing their own underwriting twice. So it's like super monitor, right, to make sure nobody's screwing up the numbers. Um, Dude, what would you recommend to someone that wants to start getting investing in syndications? What would be, whether passive or active, what would be your number one recommendation?
Yeah, I have this conversation a lot with investors right now, and for me, I think the best way to get started is to invest passively in a deal, especially if you're new to real estate investing. Because when you invest passively in a deal, you do a lot of your due diligence up front. So you want to make sure you know who your general partners are. You want to develop a relationship with them because you're going to be invested in a deal potentially, for up to 3, 4, 5, maybe even more, years. Um, but for me, I think that's the best way because you get to network, you get to understand how a deal is put together, um, and it gives you a level of comfort then that if you wanted to become more active in multifamily, say you want to then become a general partner, then you can more easily make that leap. Um, and that's exactly the path that I followed. My first couple of investments in multifamily were in syndications, where I just wrote a check after I met with the general partnership team. I wrote them a check and handed it over. And for me, that was a big deal because I'd always been the one managing and doing all of the work. So it was kind of a big deal for me to not have that kind of control. But it also kind of started me down that path of learning, networking, finding the right mentors, and then, like I mentioned earlier, joining a mastermind group. Um, and then that really kind of then catapulted me into being a general partner.
Yeah, love it, man. If What would be some a book, a real estate book that you recommend someone?
I hate to be so obviously, Robert Kiyosaki, Rich Dad Poor Dad. I mean, that's a classic. But I'll give you one that kind of influenced me a little bit. And all politics aside, but Trump's Art of the Deal. There are concepts within that book. Hey, there you go.
Yeah.
um, all politics aside, there are concepts in that book which are pretty powerful, and I still think about them and use them today.
Yeah, dude, I love that book, man. There's so many things, like you said, so many concepts on the way he structures deals that are uh, very mind-boggling, right? Like it makes you think, like, wow, there's a lot more out there that I can do just than a straightforward transaction. Um, that's awesome, man, dude. We're reaching the end of the podcast here. Where can people find out more about you and potentially invest with you if they want to get started in syndications?
Yeah, so my website is sastexascapital.com, and that's a great place to start. You can see previous deals that we've done. sign up for my newsletter. And my email is simon@sastexascapital.com. You can email me directly, and I'll be happy to respond, personally to anyone.
Dude, love it, man. We'll put all those links below the show notes. And that way people can access them a lot easier. Simon, we appreciate you having you today in the show, man.
Hey, it's been great being on the show, Satch. And again, I really appreciate the opportunity to come on and, again, hopefully provide some value to your listeners.
Cool. Love it, man. Thanks.
All right.